Decade of revolution. This is Darius Dell here, senior analyst on the Hedgeye macro team, to welcome you and all of our new audience members to our decade-long celebration. Not a decade-long celebration, actually, the celebration of our decade of independence. To welcome you to another edition of the Hedgeye Macro Show for Monday, April 2nd, 2018. I'm joined in the studio with Hedgeye CEO, the founder of it all, Keith McCullough. As always, if there are any questions, pop into the chat stream. We'll try to get to as many as we can before the end of our allotted time. With that, take it away, Keith.
Thank you, Darius. I am indeed 10 years old today. Let's get into the wood. Again, top three things in my notebook is what we do first, then we'll go around the world, then we'll take your questions. Top three things in my notebook this morning: volatility, going to talk about that, and some volume signals. Going to talk about Asia, and then finally going to hit on 10-year bond yields that got hammered by reflation's rollover last week. First, on volatility, however, Thursday, don't forget that it was the long weekend. Going into the long weekend, we all had a long weekend. As you can tell by looking at me, I look a little chubbier than I did last week. I get a little chubby on the weekends, especially when I eat all weekend long. That's another thing that's happened in the last 10 years. I'm a lot chubbier. But again, coming into the long weekend, what happened? You had a no volume rally, to lower highs, and that's a problem. On top of the fact that it did not get confirmed by any breakdown in volatility. So again, for those of you that use our process and you don't use the old walls moving monkeys, and again, you know what a moving monkey is, it's a moving average, please don't do that. That's a single factor point and click model that your children can use that are indeed 10 years old and younger. Let's use the price volume volatility model, and you look at it for what it is. On Thursday, it was a lower high. Josephine could show you what the volume looked like. Again, this is hard data. It decelerated materially, so versus the prior day as the way to read this, and this is total U.S. equity market volume, including dark pool. That was down 6% versus the prior day, down 20% versus the 1 month average, down double digits, obviously, versus the 3 month and 1 year average. So again, volume didn't confirm and volatility didn't confirm. You'd have to break the VIX down through 13.5 to change that. And my vol of vol, if you didn't know what the vol of vol, you are definitely not going to hear about that this morning. You're going to hear about people driving their Teslas on old wall. Again, qualitative discussions. We will maybe, again, entertain you with the odd comment, but come on, man. Let's focus on the data. Again, if you look at the vol of vol, or the volatility of volatility, we currently have a risk range on the VIX of about 16 by 25. 16 by 25, so plenty of upside in volatility, which means plenty of downside to the low end of the risk range in the S&P 500 of about 3% to 2560. That's the low end of the range. You might hear things about the risk ranges. Again, that's how we roll. We talk about where the market is within its defined proprietary at Hedgeye risk range. And again, I'll come back to that. Point number two this morning is Asia. Why do I care about Asia? Because when I do global macro, I do all of Asia. I do all fixed income. I do all of currencies. I don't just stare at the Dow, bro, and points or moving monkey averages. No. That's what you can do for free, again, watching the old wall on its TV. But again, if you look at what's happened in Asia overnight, because Europe was closed, don't forget Easter Monday, and again in my home country as well, in Canada, we don't work on Easter Monday. We try to get less fat or less chubby. That's what my mom would say. And again, if you look at the rest of the world, Europe was closed, and what happened in Asia? Wet Kleenex type reaction. And again, you had the S&P 500 up 1.4% on down volume and bad vol signals, but at the end of the day, you would think that maybe Asia could have an up day on the heels of that. Not so much. Both Japan and China remain bearish trend. We'll show you a quick chart, I think, of Japanese stocks, which we don't like. No, we don't like them. They're down about 11.5% from where they peaked in January, but the Nikkei is down, again, down 0.3%. That's not up. Shanghai Composite, not up, down 0.2%. So that's the read-through on Asia overnight, just to give it to you quickly. And again, we don't like most Asian equity markets. Just FYI, if you're looking for something to short in Asia, Indonesia or India both have bounced in kind, but again, those to lower highs, and we'd be a seller of a lot of EM or emerging market Asia. Point number three this morning, 10-year yield, just smoked. We have a chart of that. Got a chart of that handy this morning, some lower highs. Show you some little dots. We call this reflation's rollover. 1 dot, 2 dot, 3 dots. So that's what that looks like, lower highs. 1, 2, 3. 3 lower highs in a row. After Wall Street had you chase inflation expectations at the February highs. So again, when inflation expectations are high, bond yields go up. When inflation data is accelerating and inflation expectations are going high, bond yields really go up. As you can see, go back to that chart one more time, Josephine. These things went up a lot in conjunction with oil's price. If you go back to where we were in the fourth quarter. So again, that's the big point here, is that bond yields have rolled over because hashtag reflation has rolled over. So again, that's why the bond yield has gone close, or at least got close to the low end of the risk range. That risk range for the 10-year yield is now 272 by 283. Okay, so again, that risk range, we tapped the low end of the risk range or close to it last week. So I do think that a rollover in inflation expectations is starting to get priced in. So that was a call that we've had for about 6 weeks that I'm not going to be making as forcefully because we got paid on it. Again, you'll get paid in a lot of different ways on that. You could have been long bond proxies or not short them, being utilities, for example, consumer staples, two of the best performing sectors last week. Just not being short them was the key after being short them in January and February. So a lot of pivots within the pivots. If you're not just a stock market monkey, you do pay attention to the bond market because it helps you get the stock market and its sector styles right. Those are your top 3 things. All right? How's that?
Pretty good.
Not bad, 7 minutes. All right, we'll do another 5 minutes and then you guys can ask some questions. All right, let's get into, quickly, we'll get into what we call the risk range, which I've alluded to here this morning. S&P 500 risk range. So again, 2560 is the low end of the range. So that's what I meant by that. 2560 is the low end of the range. 2693, I believe, is the top end of the range. So on something like that, that's what we're paying attention to. Where is the probable range of the market? This doesn't have to do what is the possible range of outcomes. Okay, possibility is what anybody on TV can talk to you about or write about or a journalist would just discuss. We're going to have a 1987, or it's going to be 1999, or da-da-da-da-da. Just wah-wah-wah-wah-wah-wah. I care about where the market is most probably going to go. So there's 3% downside from Thursday's close in the S&P 500. That's 3% downside versus where we closed. Okay, so that's 3.0. That's too much downside for me. That's, first of all, I'd much prefer to buy or cover shorts at the low end of the range. You have 2% upside versus 3% on the downside. Whereas the risk range that I have for volatility, and by the way, if you didn't know, now you know, I write all this down all the time because I'm a chubby nerd. All right?
You're being too hard on yourself.
Just FYI. I am getting chubbier, Darius. There's no doubt about that.
That's true.
Okay? So again, 1639, I'm very specific. As opposed to saying, I'm Mr. Wonderful. I'm going to tell you what I think about the market with no specificity. I mean, 2593. Okay, so this is math, okay? I'm not wonderful, and I might be chubby, but the reality is I'm trying to help you, okay? I'm trying to help you by letting Mr. Market help you help yourself. And that's really the point. We have risk ranges daily for everything. So if you want to pay for our daily risk range product, you can get it there. Early look note, we put a lot of them there. The daily range is the most probable range of outcomes that we are going to deal with today. And that's starkly contrasting with any journalist or anybody who's never played the game before. They like to talk about the game that they'd like to see politically or emotionally or something, from an advertising perspective. We play this game like the one that Mr. Market says you're in. So we're much more interested in playing the game that we're in and talking about the economic data that's happening than what should be happening politically, emotionally, or otherwise, okay? So something stylistically to just pay attention to. Looking at the sector studies, Josephine, if you could show the bongo board. These are the returns for the S&P and its sectors for the month of March. It was a terrible month specifically for growth stocks and the financials. So the financials was one other way to play a rollover in inflation expectations because it was called a rollover in bond yields. So again, if you look at that chart of the 10-year bond yield and you look at the negative 4.5% return in the XLF, which is the financials, you would say they look the same thing. They go down. So that was an important pivot to be made there is within those things. That's one of the things that we didn't want people to be long of, which were the bank stocks. And I don't know if people were buying those on pullbacks or not. That's certainly not what we told people to do. Just doing a quick run around the world. Already hit on Japan, Asia most specifically. Europe's easy to touch on because there's nothing going on. You can touch on Russia, which is one of the few stock markets that is bullish from a trend perspective at Hedgeye. Again, bullish trend is your friend. So a very revolutionary looking color-coded green arrow there. We, the technicians at Hedgeye, deliver that to you this morning. The Russian Trading System Index up 70 basis points this morning. But again, it looks just like an oil chart. So again, if you want to be bullish of oil, because it says bullish trend at Hedgeye and it says it's green. So again, that's the daily trading range product. We also give the trend in a color-coded setup. And again, we actually do have some subscribers that we've learned over the last decade that are indeed colorblind. So there's nothing to be made fun of in that regard. It does actually say trend, however, so in that regard, you can pay attention to that as well. But again, everything has a reason in macro, a causal factor. Why Russian stocks are outperforming European stocks. Why I don't like Europe is, again, pretty simple. European growth and inflation slowing. That's something to hit on again this morning. That was a big theme that we had in the first quarter. So whether it was German stocks down like 6.5% for the year to date, or it's Russian stocks that are doing a lot better than that, up for the year to date, you would have been set up properly in Europe. You wouldn't have been long Europe, and if you wanted to be short Germany, you could have bought Russia on the other side of it. There's a lot of different ways to use the process, but the point about the process over the years is to give you something that you can help augment your process. So again, lots of tools, a lot of thoughts. I'm not trying to do everything for you. We do make explicit calls, obviously, like short Europe. That's pretty straightforward. And buy European sovereign bonds in the face of European bond yields falling. So when inflation falls in Europe, last week's Spanish 10-year bond yields were down 11 basis points and are down about 40 basis points for the year to date. Why do I remember all this stuff? Not because I have a teleprompter, because I wrote it down. So again, you study it on the weekend. I ate a lot of chocolate, got a little chubby, but I also, you got to write this stuff down. You got to study it deliberately. Okay, the deliberate study, that's critical to being essentially focused on what markets could be doing next. What else do I got going on? Oil, just to give you the risk range, 62.08 to 66.75. Okay. 60. So we'll just put that at the top end of the range. Okay. So that's the top end of the range. Can it get greater than that? That's the top end. Okay. Josephine, you got a chart of oil? If it can't get above that, so that top end of the range really matters. Low end of the range around 62. So I put a question mark there because it couldn't get above that at its highs in January. So again, it failed there last week. Don't forget that oil was down about 1.4% last week. Again, I wrote it down, I remember. So again, you don't have to take my word for it. I wrote it down because again, these are just facts. So again, these facts aren't political. They're not emotional. Again, oil was down last week. It tried to open up higher this morning. It backed off. It's backing off at a very important point. That's not to say that oil isn't bullish. It's just to remind you, if you look at CFTC futures and options contracts, which is the positioning of the market as opposed to what somebody might think that the market feels or should be. Again, we underline these things that are outliers. At this point, you can see that oil's net long position is 759,000 contracts. So I'd say that people are adequately net long of oil. That's the biggest net long position in all of macro. The biggest net short position remains treasuries, albeit it's a much lower treasury position now that treasury bond yields have fallen. The biggest call out there, Darius, on this one is actually that people are really long SPYs again.
Yeah,
okay. So you can see that I underline it in red. That position is over 209,000 contracts net long. Relative to itself, that's almost 2 standard deviations of where it's been in versus the 1-year average. So that's where that 1-year column adds up. So again, you can look at that and say, wow, it's 1.86 times or 1.9 times, 1.96 times relative to itself. So again, when we talk about the position of something, we look at everything and then we look at it relative to other things and relative to itself. Okay? So again, just using math, using rate of change, this is how we roll. Obviously. What else do I got going on for you this morning? There's a lot going on. Bitcoin still looks like hell. If you cared, we've been bearish on Bitcoin going back to where it was peaking and rolling, and now it's crashing. Obviously, 7,400 was the close last week, or at least where it went out. And we have an immediate term risk range for Bitcoin as well. So low end of the risk range there is 72.68 if you're looking at buying it on an oversold signal. I don't again, judge people for doing that. Again, that's the whole point about a risk range is that when you hit the low end of the range, which for Bitcoin is 72.68, why not buy some? I mean, especially if you're a bull. I'm a bear, so again, I'd be much more in the camp of short covering. Again, Bitcoin has not got the liquidity that we would like as a short seller. It's one of the problems I have with it. Maybe over time with all these very, very, I guess, confident Bitcoin people, they should be very confident in letting short sellers like Keith McCullough and all of his friends short it with, again, liquidity. Liquidity. Obviously, you can buy futures and options in Bitcoin these days as well. Maybe a good spot, Darius, to take some questions.
Yeah, and just real quickly before the questions, I wanted to highlight another reason why Russia was up. So we just got their GDP data as well. Russia's been tracking in quad 1 for most of Q1, and our forecast is that it will be in quad 1. However, we're forecasting a transition to quad 3 for Q2 and Q3, so we wouldn't necessarily be chasing Russia here, but that's another reason why we think Russia has been outperforming as well. So something to keep in mind.
Actually, that's worth a teaching point for those of you that are new, and thank you for joining. There's a fair amount of new people that are watching here. When you do it for free, that's what happens. Go to the 4 quadrants slide if you could, Josephine, if we could show slide 5 in the current macro deck. Just the quadrants, okay? So again, as opposed to talking about nothing or what Elon should have or should have not tweeted, I'll talk a lot more about this. By the way, keep shorting Tesla on bounces. But again, 4 quadrants, okay? So this might look busy to you, but I can assure you, you should be busy if you want to do this job right. Never apologize for doing a lot of hard work and being mathematically driven as opposed to politically driven or advertising driven, all the different things that you shouldn't be doing. We have 2 factors in macro that we want to care for. One is growth, one is inflation. We care about the rate of change in these 2 things on a trending basis, 3 months or more. So the trend is your friend if you get those scenarios right. If you have growth and inflation accelerating at the same time, that's called quad 2. That's what the U.S. economy was in solidly from September through January, okay? Now it's subtly in quad 2. Solidly versus subtly is different. Solidly is very obvious. When you're in quad 2, bond yields go up, financials go up, energy stocks going up, tech's going up. It called the all-time highs. We unfortunately got that right. So that's quad 2. Darius currently said that this is where Russia is. We have this for 50 different countries. Again, we model it all day long because we're such wild and exciting people over here. But again, it's a lot easier than keeping 5,000 stocks in your head and blowing horns. Okay, so that's important. So this is quad 1 is where Russia is. So that's where you have a subtle rollover or a trending rollover in inflation, and real growth is accelerating. So this is the real growth sector. A certified monkey can buy a stock market in that sector, including the guys with the horns. Okay, quad 4. This is a gong show. Okay, this is where you need gongs and horns. Okay, so quad 4 is when you have both growth and inflation slowing at the same time. Okay, and then in quad 3, where the Fed typically takes you when they see that growth is starting to slow, they devalue the currency and create the illusion of growth, which is called stagflation. So you get inflation accelerating as real growth is slowing. So quad 3 is very bad for stocks, by the way, and we actually have a quad 3 forecast for the 3rd quarter. We're currently in the 2nd quarter, so maybe Mr. Market is front running. You know, maybe the bear has appeared because the bear is pretty good at discounting the future. And by the time we get to what was discounted as the future, we're looking backwards at a risk. And I think that those are the big risks in the market. We've been discussing them for the last month. What happens if GDP growth slows from its cycle peak? We're currently the low on Wall Street with our GDP forecast for the 1st quarter. Headline, it's right around the cycle peak on a year-over-year basis. The other big one is profits. What happens if they slow, both absolutely and relative to expectations? And then the 3rd one is what happens if the market is breaking down in kind, okay? So those 3 things happening at the same time, the bear is staring you right in the face. And it's not me. You know, I'm much better looking than a bear, obviously. Look at me. I mean, but we do have pictures of bears. If you want to see bears, I'm from Thunder Bay, Ontario. I have to deal with these live animals quite often. Been bearish many times in my career and quite happy to be bearish right now on the bounces. Again, sell the bounce. No longer buying the damn dip, selling the bounce for now. And if we change our mind, you come back to Hedgeye the next day and we change our mind. We're not one of these people that says, I will be bearish of stocks in yen terms until I come back on TV again. No, that's not how we do it. We do it much more specifically than that.
That's pretty good. Awesome. Let's keep moving here. Let's get to the queue. So Nick's asking, what's after the decent fall in U.S. equities, are you now most bearish? Are you bearish on most equity markets, including the U.S.? What size fall are you expecting? Something in the 10% range, 20% range?
Well, we've been bearish on pretty much most equity markets
equities,
other than the U.S. For the last 3 months, going on 6 months in Europe. So we're bearish on all of Europe, not bearish on Russia. There are certain parts of, again, we'll be specific about it. We've been bullish on Colombia, for example, Mexico. So not bearish on everything unanimously, but bearish on Indonesia. Went from bullish in India to bearish. Again, a lot of things. We're bearish on Japan, China. Actually provide the top 6 things that are now bearish trend in the early look. That's when I get up this morning. I get up every morning at the same time, but at 4:30 I get up, I rinse and repeat. I do the same process over and over and again. The team's feeding me data. You can see me tweet about it. I'll stop tweeting at about 5:30. Then I'll write this thing called the early look, which is basically my time with my own dangerous thoughts, which is data. And again, I'll summarize in the early look notes. So we'll have 6 markets that are all signaling bearish trend currently. So what's happened in the last 2 weeks? is that the NASDAQ and the S&P 500 have joined the Shanghai Comp, the Nikkei, the DAX, the Spanish IBEX, for example.
Oh yeah, absolutely. All right, let's keep moving here. Cesar, congrats on 10 years. Thank you for your service. From Jeff, it's been truly incredible how your team has made trading, timing, and asset allocation easier for me. So we appreciate that, Jeff. Thank you for joining us. Do you see any stress in credit markets that can impact consumption growth?
I mean, it's just something that we're constantly on the watch for, but the biggest stress has been in the equity market.
Yeah, no question.
So again, if you look at, actually, I don't know if we have the global volatility data series readily available, Josephine, that shows year-over-year global vol, again, global volatility in equities versus currencies versus fixed income. What you're going to find in fixed income is that actually the volatility has been falling as bond yields have been falling. So it's actually been a place of refuge. That's why being long German 10-year bonds or Italian 10-year bonds, or for that matter, the U.S. 10-year government bond for the last 4 to 6 weeks has been a very good place to be. So we've not seen it in sovereigns. We've seen some spread risk develop in corporates. But again, that should really, there it is, nice job. So you can see on a month-over-month or a 3-month basis, there are very few things in this world that have volatility that's actually down. And you have to get into longer-term dated treasuries and fixed income space to find something like that. Whereas, it's been horrible for equities, and that's not just U.S. equities. We're showing obviously a broad swath of a breakout in volatility in equities. So that's where the real money's to been made on our call. Our call is called global divergences. Okay, so global divergences is quite simply that the world is not in a globally synchronized recovery anymore. It's on the cusp of a cyclical slowdown that's pretty apparent at this point in Europe and parts of Asia, specifically China. So again, there's a lot to do when you get globally synchronized divergences as opposed to globally synchronized recovery in perpetuity as an expectation. And I would submit quite humbly that anyone's pie chart who got long a globally synchronized recovery at the beginning of the year in their 401k, looking backwards, because that's what we had for almost 2 years, they got killed. They're sitting there, Easter Sunday, and they're probably hopefully having a nice day. But if they're reviewing their 401k and they're long China, Germany, Japan, and some version of the US, it's not good, okay? And it's not good because the data's not good. So again, remain data dependent. Don't be political, don't be emotional.
Yeah, absolutely. And just going back to consumption growth specifically, we focus on everything from the credit side, but there's probably 3 things going on the income side that are actually more of a near-term headwind to consumption growth. One, income growth is actually decelerating modestly. It did in February. The savings rate has ticked up for the 2nd consecutive month, so obviously that's a direct hit to the consumer's capacity to consume. And then also you have the wealth effect. So you had confidence peak back in February on the conference board reading, and then you also have markets, financial markets, obviously in turmoil here. Those things have been historically very inversely correlated, or very positively correlated to rates of consumption growth that are inversely correlated to the savings rate. So it's kind of a trifecta of negative news, and nothing's trending negatively yet from a reported data perspective, but that's something that could start to manifest as we roll throughout the back half of the year from a base effect perspective.
Yep. So that's really the answer. As opposed to, actually, there was another question before that, and I apologize for not answering it specifically. But the apology is not going to be because I didn't have a specific answer. It's because I forgot to address it. Now, to have an answer to say that the market should go down 10% or 15% or to a magic multiple of earnings, that, just for the record, is complete bullshit. That's what the old wall has taught you to do. So we're going to teach you what not to do. So again, a real simple way to start to risk manage where a market can go is identifying where, first of all, the economy is in that market. Is it going to the 3rd or the 4th quadrant? So again, is it going to one of these 2 places? Because one of these 2 places can give you massive multiple compression. In the 1970s, when you had stagflation, the S&P earnings trade at 7 times earnings. So if you want to do this, the Wall Street, get yourself on TV multiple math, the magic multiple, where the market could go, why don't you just slap 7 times earnings on the stock market, and I'll tell you that it's a lot lower. Okay? So that's not what we do. So again, we're trying to identify the timing. That's why market timing matters so much more than saying what the market should trade at. Okay? So if I take this off here for a second and get rid of this, get rid of all these numbers. People, the numbers, they'll get you every time. But I'll tell you, let's do this one in red. Okay? So if we get S&P 500, so first of all, S&P 500's all-time high was 2872, I think. 2872. Minus where we are where we close 2640 on Thursday, Darius? Is that right? 2640. So let's say that that's, I don't know, minus 8. Yeah, minus 8% has been your correction. So your correction so far is minus 8%, and then I gave you the low end of the range is 2560. So minus 2560, that's another minus 3%. Okay, now we got, around 11%. Now that's isn't that a much more tolerable answer than just using a round number like, so do you think the S&P can correct 10? I mean, no.
Big difference between
we got to
10
be
and 20.
much more specific. Where is the economy? Quad 1, 2, 3, 4. Where is the current drawdown? Where is the risk range beyond that drawdown? Now we're talking in Hedgeye speak, okay? That's what we want to be doing. We want to be much better at this than the old wall. The old wall has failed you many times, and we will make mistakes. But we constantly make decisions that are probability based within the framework and the process that we built.
Yeah, totally. And it's certainly no arrogance implied in this comment, but I think there's something you said about being specific. If you sat behind my computer, your computer every day, you'd see us doing the same things every day. It's very quantitative, it's very rigorous. I don't know what Mr. Wonderful does on a day-to-day basis. I can tell you it's not the same thing every single day. I can tell you by his own answers to his own questions when he talks to himself a lot on TV that it's very different. But that's one of the things we strive for here with research revolution, research independence, is being very specific, being very quantitatively oriented. We're obviously not the smartest guys in the world, never will we be or never will we want to be, but we're definitely going to be hardworking guys who try to give you with specific answers and specific timing with those answers.
Yes, indeed.
Awesome. Jeff, let's move on here. Can you explain some of the tail risks associated with the 12 trillion of currency, I guess, I assume it's U.S., sitting on the Fed, ECB, and Japan central bank balance sheets? What could the consequences of these be, and how could they might affect global markets? Okay,
they're very bad when the economy is doing what? Not when it's accelerating. Mm-hmm. That's what all the people on Zero Hedge had wrong for about the last year and a half. Is that when you wake up every morning, and there is one consistency, Darius, that they do. They're marketing or advertising every day.
Sure.
They're either marketing fear, or joy, or happiness, or
products,
whatever it is. Okay, Procter and Gamble's commercials. What matters when it comes to big items like 12 trillion in debt, demographics, deficits as far as the eye can see, and again, demographics that are driving a lot of these causal factors that, again, we constantly have to be paying attention to, but the causal factors that really start to manifest in the market are market-based, okay? Markets start to say it matters when the economy is doing what? Not when it's accelerating, when it's slowing, okay? So when it's slowing, that's when secular issues that you're concerned about, they're very well marketed. By the way, I've never missed calling a stock market decline on a major magnitude. And I'm not trying to be arrogant about that. That's just a fact. And it's a fortunate one because I don't think a lot of people can say it. So again, if I go back across my career, the number one reason why I've never missed calling a bear market or been making money in a bear market, started the firm 10 years ago. Again, it wasn't luck. It was in 2008. We're calling for a crash. It's when all these secular issues, these long-term issues, secular, write it down, that's secular, versus the cycle, met each other. And they said, we're both going the wrong way at the wrong time, okay? And once they're going the same way at the same time, it's a big problem. It's a mess when the economy's slowing. When the economy's slowing and markets are breaking down and these secular issues have not gone away, that's when it really matters, okay? When the economy's accelerating, what does it do? It devalues those risks. And the other side of those risks you start to make money on, okay? That's why I don't know if you can tell, but I like to go both ways. That's why. Because if you understand the secular issues, you should understand how to trade the bull side and the bear side of the equation.
Absolutely. All right, Jeff's asking one more time. On the basis that we do get quad 3 or 4 later in this year, which we're obviously forecasting according to our GIP model, how long until U.S. equity markets start discounting that change in macro, or do you think it's underway?
It's underway. I mean, it could be underway, and then it could stop being underway. That's why we wake up with, God willing, 2 feet on the floor every day and do our job again, readily willing to change our mind on that if Mr. Market changes his mind. But what's not going to change its mind is time and space. So, Josephine, if you show our GDP turtleback green on slide 39 ahead of the Masters. Without a teleprompter, that wasn't bad.
That was pretty good. I was like, wow.
All right. I'm working on it. I know I'm not as good as these guys on TV, but I want you to focus on the potential at Hedgeye. Has always been that we will get better every year, and certainly they'll only get worse. So see this is pretty straightforward. Let's do the good part of the movie first. Is it okay if we do the good part of the movie? So when Hedgeye went bullish, it was right in here, between Q3 and Q2. Why? This is year-over-year GDP, okay? It had slowed. That, actually, apologies in advance, this should be very red. That was red, okay? GDP slowed to the lows. That's where bond yields bottomed in Q2 of 2016. This is where we were long the TLT. Longtime subscribers like that one, okay? The TLT, you buy long-term bonds when growth is slowing. When growth and inflation are accelerating at the same time, you short those TLTs. Hopefully you did that too, okay? So then you get this massive wave of greenness, okay? All the way up to here. Look at that. That's a pretty long acceleration. We stayed bullish the whole way, bought every damn dip. Again, up, 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 up. Every one of these numbers is up versus the prior number. That's called a rate of change acceleration. You don't have to be a second derivative math expert to understand that. Drive your car, when you hit the pedal, you accelerate. That's the rate of change is accelerating, whereas here it was slowing. That's called hitting the brakes. Okay, so again, this is why we care about measuring and mapping the economy on a rate of change basis. Okay, so we get all the way up to here, and guess what? First quarter just ended, Pontiac. Okay, whether you're driving a Pontiac or whatever, I just all of a sudden see to myself, okay, is Mr. Market starting to discount that we go here? The blue bars, by the way, is our forecast, because I like blue, yield blue. Okay, so this is the point. When is Mr. Market going to discount the future? That GDP growth is slowing again? Well, maybe it's now. I mean, why wouldn't it be now? Mr. Market doesn't wait until everybody is properly positioned. He certainly doesn't wait for everyone to be long S&P 500 futures again because they say, okay, the Trump tariff talk is no longer. All these macro tourist items suck you in. They distract you. When all you have to really do is get the rate of change and the shape of that sine curve right. The rate of change, where is it going, up or down? And we're going into a very difficult time where against toughening base effect or steepening base effects, the probability rises that you slow against the prior year's acceleration.
Absolutely. All right, let's move it on here. Let's get a few more before we wrap up. Amy's asking, how are you thinking about LIBOR OIS spreads, which is, I think, the tourism topic of the day.
Yeah, well, I mean, what's happening is that you get front end. So again, when the Fed is typically, and don't forget, the Chinese also tighten, and they tighten in Hong Kong into a slowdown as well. China's actually in a slowdown, and they're tightening. Whenever you start to tighten into a slowdown, you start to see, you can look at HIBOR versus OIS, again in Hong Kong. You start to see tightness. Again, risks start to develop. But that's a macro tourist topic of the day. That really is one thing that you'll observe along the way. So again, as you go along the way of these growth accelerations and decelerations, what you're going to find is that these many little topics that macro tourists like to find. Again, don't forget, being a macro tourist is just reading about something. Oh, look at that. I can sound really intelligent talking about LIBOR versus OIS. Hedgeye incorporates it all in the process the whole time. LIBOR versus OIS didn't get us out of the market. The quad process did. The trend signal did. The process. And then you're like, oh yeah, I see what's happening in LIBOR. That's part of your job. You write it down every day. Okay? Being a tourist is very dangerous, as you know. Again, especially when locals know what they're doing. So again, that just a way to, and I'm not trying to say that your question's not a good one. I'm just trying to say that that is a good example of something that everybody's talking about right now because it's a wild and interesting thing to talk about, but maybe not. I'd much rather get the GDP growth number right myself.
Oh, totally. Absolutely. Again, it's all mosaic theory. If it rhymes, it works.
Yeah, you'll just wake up in, when is the GDP number for Q1 going to be reported in April?
April 27th.
On the, late in the month?
Yeah, late.
Wouldn't it be easier for, who is the subscriber asking the question?
Amy.
Wouldn't it be easier for Amy to tell her husband or brother or her sister or her parents for that matter, the stock market's going down because Hedgeye's got the low on Wall Street on GDP.
April 27th.
That, I think Grandpa might understand that better than LIBOR OIS. That's probably a bigger reason that's driving LIBOR OIS.
Yeah, I venture to say most people have no idea what overnight index swaps are, but it is what it is.
Yeah.
Steven's asking, since we may be sellers going forward instead of buyers, what are your favorite tech shorts, actually? That's a good question. And that are likely hardest to be hit since they went up a lot in 2016, 2017.
Well, we've been bearish on Facebook, if you want to call that a tech stock. So again, in the daily trading range product, we actually show the three best shorts I think we've had lately are Facebook, Google, and Tesla. Tesla being the one that we've been bearish on for longer than the other two. But our signal went, again, it says bearish trend. It's red. Facebook's red. Facebook today would be a good spot to sell some, especially if it bounces again, because it's bouncing to a lower high and should, again, make lower lows, in as much as the same view is on Tesla. On Tesla, actually, we put up a lot of content that we started as an institutional research company. We still are. Over 90% of our revenues are institutional. So in other words, we validated high quality research, the best independent research we thought available in the marketplace, almost democratizing a hedge fund manager's short selling process into the institutional community, and they pay us. Okay, so all the people that you think are super smart probably pay us, and if they don't pay us, then they're going to get smarter. I think that once they see our ideas, like the Tesla idea is a very good idea. We're the only ones who timed it properly. I think we've been right on the order of 30+%. Again, timing matters as a short seller. So again, all these institutional research products that we have, we're starting to give you some snippets of the ideas. We gave Tesla actually for free. I think that was a pretty nice thing to do for people, just because a lot of people own Tesla because they like the cars. And that's not a really good reason to own the stock anymore, just FYI.
Gotcha. Makes sense. What do you think about gold? Switch it up a little bit.
Sideways. Gold's trading with the dollar, and if you look at the inverse correlation, Josephine, if you could show that, you get the dollar right directionally, you're going to get gold right. So last week, for example, so as you can see there, gold, the inverse correlation, so 90% of the time on a 15-day basis, it's going to go the other way. If you go to 90 days, it's 92% of the time, 120 days, 91% of the time. So in other words, it's enough percentage of the time that I'll stay with that. Again, so last week the US dollar was up 0.6% and gold was down 2.1%. Why? Because that's the correlation. So again, I'd stay with that. That's the best way to risk manage gold. It's trading within a range. And the bigger question here is the dollar bottoming from an intermediate term perspective. We're going to go through that tomorrow with institutional subscribers on our Q2 macro themes call with a question, which is the US dollar bottoming?
Gotcha. A few more here. What do you think about Biotech, short term, intermediate term?
Off the horse. So that was a good ride. We're off the horse, taking Biotech off both. Did we take it out of ETF Pro yet, or are we allowed to say that?
No, actually, we're not.
Well, we didn't say that. We were saying that we're taking Biotech. I didn't have to say it. It's not new. I've been saying it for weeks, if not more than that, that I'm not a buyer of Biotech because it was breaking down through my trend signal line. And again, if I don't buy it, that's a pretty good signal that I don't like it. Real-time alerts, there's over 4,000 signals I've issued since 2008. Every single move, the good, the bad, the ugly, it's all there. If I'm not buying it, and moreover, if I already sold it, that probably gives you a pretty good leading indicator that I don't like it, as opposed to just talking about things every day.
Gotcha. Do you like the pound here?
Yes, still bullish on the pound. We've been bullish on the pound since well over a year from now ago. Around 118, 117, we got bullish on the pound. Still has immediate term upside to 142. That would be the top end of the range. So if you're trading pounds, again, use the risk range, top end of the range 142 or 141-ish and a half, and that's how we do it.
Gotcha. All right, I'll end with this quote from Arden. It says, Keith, I always remember back in the day when you were on Fast Money, would say, play the game in front of you, not the game you think should be played. He lives by that motto, so keep up the amazing work.
Oh, cool.
Appreciate it. All right, thanks.
And thanks to all of you. We appreciate it. It's been 10 years. Feels like it went by in maybe 10 months. So hopefully the next 10 years is just as much fun.
Cool.